Okay, ladies and gentlemen, please take your seats. Welcome everybody to this afternoon session. My name is Bernd Wilke, for those who haven't seen me last night because I spoke in German there. I'm from Swiss Reinsurance Company. I'm the top topic manager for food security, and I have the honor to chair this afternoon session that we have here. Which I think will be a great one, because yesterday I mentioned we have 4 pillars to food security. That's the availability and affordability, but it should also be nutritious, and since I come from an insurance company, I normally say it should also be resilient, and we have speakers who will touch most likely on all of these aspects. Before we start, a few logistics. I will keep a rather tight time schedule because, as we know, we all have to go to Titlis tonight. You can either take a bus at 5:30 at the train station, or you will be at the base station of the Titlis Bahn at 5:30, so that we all get up there. And to assure that we can all do that, because one or the other person may want to put on a different coat or different shoes, we try to finish here 5 minutes after 5, so there is 25 minutes in between so that everybody can arrange himself. Apart from that, also a little bit logistics. There's a blog at the Academia Engelberg site. If you go outside, you will see some of the blog entries on screen. You are very much invited to comment there and also have a look. And the same is true for the work that our young scientists did 2 days ago in Gravenfort, because they worked on 4 countries and the aspects of food security for these countries. The countries are Ethiopia, Ethiopia, Russia, Brazil, and Pakistan. Now I got it right. The posters are now in the coffee zone because they were all the time behind all these cameras, and I think people thought, oh, I'm not allowed to go there. You are, and the students are actually also outside during the coffee break, so if there are any questions, they're happy to answer them. This said, I think I went to all my logistics stuffs and have now the pleasure to welcome our 2 first presenters. There are Marco Haase and Alex Tobler, and they will talk about the properties of commodity, spot, and future markets. And we talked a lot also about food prices in the last 2 days and how they spike and not spike, and what the effects for a large part of the population on this globe is. And I think it's very important that we understand how these markets work, who actually generate these prices. Marco Haase is currently at the Department of Finance Theory at the University of Basel, but before he did that, he had actually a lot of practical work experience. He worked in the Treasury Department of several German banks, especially on the asset and liability management side, and is now specializing in these markets. And Alex Tobler, he's currently Picard Angst Asset Management. He's also concentrating in these issues. He has a Master of Arts in Banking and Finance from the University of Zurich, and both are also members of the Commodity Club Switzerland, which, for everybody who is interested to learn more how these markets work and how this all comes together, to go to their events. I've been to a few. It's all the time very educating to see how the world works in that area. As said, they will explain a little bit to us how all of this works, and I welcome now Markus Haase and Alex Tobler to the podium.
So, thank you very much about the introduction, and welcome from our side to our presentation about commodity spot and future markets. I have to start with a story, actually. In contrast to our other colleagues, other speakers at this conference, we are neither native speakers or excellent English speakers, so sorry for all the bumpy sentences that will follow, and the mix between German and English probably. So the topic, speculation in commodity markets, actually started a few years ago when commodity prices spiked. So especially in the year 2007 to 2008, and again in 2010 and 2011, which caused, besides the price spike, also a hunger crisis in many developing countries. As these price spikes coincided with increasing investor demand for commodity-related products, a lot of NGOs and political parties blame actually investors for having caused these price spikes, or even worse, for hunger crisis. And what we find in this discussion is that the mechanism of the functioning in spot and future markets is widely misunderstood. And this is why the purpose of our presentation is to provide basic knowledge about spot and future markets and investor within these markets, so the role of investors within these markets. Let's have a look at the structure of our presentation. We first start with a few facts about commodity markets in the last decade. Then we go over to the causes, where we distinguish between fundamental causes for price spikes, higher prices, and also have a look at the role of investors in commodity markets and explain in detail the difference between spot and future markets. Then we end our presentation with the presentation of a few, let's say, solutions or propositions that, from our point of view, would really help in curbing further price spikes and hunger crisis, actually. So as I mentioned, the debate about the speculators' role in futures markets and spot markets began when food prices spiked. We have here on the left-hand side the chart of corn, wheat, and soybean, the price chart, where we see indeed price spikes in 2007, 2008, and again in 2010 and 2011. What's probably interesting to see here is that prices significantly declined after the price spikes. We see on the right-hand chart, right-hand side, the volatility of commodities, where we see a large spike in the named periods. What one has to add here is that commodities are inherently volatile asset class, in fact. So we had also a spike in the late 80s and the beginning of the 90s, when we had the Gulf War and the drought in the US, which impacted also the volatility of grain prices. On the next slide, we see the increase in assets under management of commodities. So this is the amount invested in commodities, where we see an increase from around $20 billion to over 400 billion at the peak. Since the peak, assets declined to around 300 billion. Now, this number seems to be very, very large, this absolute number. But if you put that in perspective of, I say, other financial instruments, this whole 300 billion are comparable to the size of one US large cap company. So Apple has twice the market cap of that amount. So it seems to be a very large number, but it's not that large. What's also interesting to see here is that assets declined significantly less than prices. So one might have the impression that on the first sight, the increasing assets under management indeed had an impact on prices, but the link might be not that direct. Now, before my colleague Marco Haase will discuss the differences between spot and future markets, we'll also have a look at some supply and demand issues in commodity markets in the past decade. On the left-hand side, we show the production growth of wheat, soybean, and corn combined on a global scale, where we see a tremendous decline in growth rates. So this is the yearly growth rate. It's quite volatile, the production growth, but the trend is deeply negative. For the reasons, I mean, there are several reasons, names for the production growth, and not want to get into detail about it. So some name less R&D investment by governments, which had an impact mainly in developed countries. We had several weather events hurting yields and decline production, or that the access to water for agricultural purposes becomes more and more difficult. When we look at the right-hand chart, we see that this is the development of production, yield, and area harvested, that this growth we had in production came mainly from an increase in yields and not from an increase in the area harvested, which expanded only modestly over this quite long period since the 80s. When we turn to the supply side, we had a steadily increasing demand, which is shown on the left-hand side with the line. This demand was driven, for instance, by the rise of emerging markets, which change consumer habits. We have named that at discussions before. So that rising population growth and increase per capita led to an increase in staple food, but also to an increase in higher protein food like meat, which need a lot of feed commodities to produce. And on the other side, you had quite a large increase in production of biofuels. For instance, in the United States, a large share of the US domestic corn consumption is, in fact, ethanol consumption. So this increasing demand coupled with slower production growth and several weather events we had in the past decade led to several production shortfalls in the grains market, which is shown over here. So that means that production was not able to keep pace with rising demand. And this in turn led to a tremendous tumble in global inventory levels. So this line shows the stocks-to-use ratio of corn, wheat, and soybean combined, which tumbled to the lowest level in decades. And this is quite a serious issue, as inventories act as a buffer for production shortfalls, and not having enough inventories at hand during these production shortfalls needs a tremendous adjustment of demand, so demand rationing. So we need higher prices to curb demand. Beside production and demand growth issues, we had also an increase in production costs driven by higher costs for fuel. We have an increase in the seed cost, fertilizer cost, and so on. We show here on the left-hand side the total costs of US wheat normalized per the end of the 90s, which shows that costs roughly doubled. Another factor putting upward pressure on prices was the depreciation of the US dollar. As the United States is a large producer of agricultural commodities, so a decrease, for instance, in the value of the currency makes their supplies relatively cheap for other countries. So this has quite a large impact for the prices of commodities. Also, the commodities are mainly traded in US dollars, so a depreciation of the US dollar versus other currencies lead to an increase in the price of commodities expressed in US dollars. So as a short summary, we had production shortfalls due to increasing demand and slower production, which in turn led to a tremendous decrease in global inventory levels. And here we don't want to get into discussion, which we often have. I mean, which factor was dominant in driving these inventory levels to the level we have at the moment? So was it changing consumer habits in emerging markets? Was it the increase in biofuel? But that's not the point. The point is we had a really significant decline in inventory levels. And that is really a serious issue, as I mentioned, as we don't have a buffer for further production shortfalls. And we had also other influences that put upward pressure on prices, like rising production costs and the US dollar. Now, the point is, this speculation also played a role during this production, during these price spikes and resulting hunger crisis, and that's the point I hand over to my colleague Marco.
So, it works. Thank you, Alex, for the changeover. So, good afternoon, ladies and gentlemen. It's really a pleasure for me to stay here and explain some issues about speculation in commodity markets. This is a topic that I heard of all people that I talk about is not really understand. So the subject of my presentation is then twofold. In the first part, I will provide some basic knowledge to understand the commodity future and the spot market and their respective price mechanism. The second part is more practical orientated to distinguish between important and especially non-important price driver. Unfortunately, we don't have the time to discuss the topic entirely, so I will limit my speech to the following aspects. The first is characterizing spot and future markets and the risk transfer. The second is I will explain why speculation is necessary in the market. And third, I show the storage is the link between spot and future markets. And then I will outline the difference between speculation and manipulation, because these items are always misunderstood. And in the last place, I will give some practical examples that price protection policy is a kind of manipulation and are mostly harm poor population and is responsible for this result. I will close then our presentation with a short summary, show the key price driver and what can be done in future. To give you a short answer to the first question, does financial speculation impact spot prices? I can say yes, but only if storage respond. Before I start with some theoretical aspects, let me define the most important participants in the agriculture market. The first are commercials and producers. We have heard a lot about them. Producers are farmers and consumers are normally Syngenta and all other companies. And they trade normally in the spot market and in the future market, in both. The future market then to hedge the price risk. We have, on the other hand, some financial speculations. They buy commodity index funds, and these are typical pension funds, banks, insurance companies, and they trade only in the future markets. Then we have speculative storage holder. This is a little bit interesting story. There's not so much written about that, but they act or trade in the spot as well as in the future market, and for the purpose to make trading profits between both markets. And finally, we have some manipulators in the market. And the question is where they work, and they work in both. They can work in both in spot and future markets, and how they act. And one important point is to understand that financial speculators are not trade in spot markets because they can't do this. And this is really important to understand. All others trade in both markets, but financial speculators not. Now, we have heard a lot about spot markets. So let me define what is a spot market. The spot market is first spread over the world. The actors trade have to trade bilateral, and they have to negotiate bilateral. The trading is physical orientated with an immediate settlement, and the delivery is all over the world spread. However, the parties have a lot of counterparty risk. So you never know whether the other party can pay, whether they deliver with the right quality, with the right amount of commodity, and whether it comes to the place you want to have it. So, as a result, we have no single quality for the spot market. We have no single spot price in the world. Even for rice, there exist many, many different prices in different locations, and we have no single spot market. Rather, we have a multitude of single transactions spread all over the world. The question is now, how can we derive spot prices fundamentally? And I use this graphic analysis where we have, this is the pointer, the demand side and the supply curve. And what we can derive is the equilibrium price or the clearing, the clearing price. This is the clearing price between demand and supply. I keep it really simple, but we have to keep in mind that the demand side is more convex, the demand curve is more convex because we don't eat more, even the food is cheap, but we have to eat something and we are able to pay, or we want to pay a little bit more just to get a little bit more food. So this is the reason why we have such a convex curve. Now, how can we increase spot prices? And this is typically assumed with an outward shift of a demand curve, like this, and represents an increasing of demand. We have heard the last days a lot about the reasons why demand have increased. On the other hand, the price can also increase if the supply is reduced. This is an inward shift of this supply curve. Now, we see we can either move the demand, or increase the demand, or reduce the supply, and both results into a higher price level than before. The the reasons for supply reduction we have heard. And it is really important to understand that the spot price only reacts to physical transactions. Now, the difference now to the future market is what, that we do not act physically. We have the following situation. We have on the one hand the producer, and on the other hand the consumer. And what they want to do is to trade a future contract. And to understand what a future contract is, it is simply an agreement to trade the physical amount of commodity, not today, but tomorrow, or the day after tomorrow, or in a year, or in a month. And the agreement includes the quality, the quantity, and the price for the good, and the delivery location. This is typically known as a forward contract, but the future contract is more specialized because the producer or the consumer does not make the transaction bilateral, so they go over intermediary, the exchange, called the exchange. And this is how it works. At time t nu, that means today, they make this agreement with the exchange to buy or to sell the commodity, but not today, in future time. And this is what then happens. The producer delivers to the exchange in a month or in 2 months and receives the money from the exchange. And on the other hand, the consumer takes the commodity from the exchange and pay the money to the exchange. So this has some special effects. First, the counterparty risk is reduced because you trade with the exchange and not bilateral between consumer or producer. And on the other hand, the contracts are standardized. That means in terms of quality, quantity, and delivery location. So that increases the speed of trading and makes it really easy because you don't have to find another farmer, another producer to make this contract. You go straight to the exchange. And no counterparty risk, I have mentioned it. Now, if we see this, the question is why we do need speculators in such a market, because we have a producer, we have a consumer, okay, it's really clear, and they trade at the exchange. There is no reason to have a speculator in such a market. I will address this with the following graph. This is a typical term structure, we call them term structure, of future prices of corn during March 2008. This here is the spot price, and these are the prices for the delivery in 2 months, 3 months, until 2.5 years. And what we also see is that the prices are different. So this is, for example, the next harvest, and the price is here cheaper than before. That means there is expected to be a different supply and demand situation compared to today, also here. And now, what we can assume is that a typically producer is a forward seller and the consumer is a forward buyer. So let's assume the consumer want to hedge the price risk in 4 months. And we have a producer with a planning horizon for 1 year. Let's say a farmer for the next harvest season, he want to hedge the price risk for the next harvest. So what we see is that they don't match. They cannot trade to each other because they have different planning horizons. What we now need is someone who takes this risk and enter into the market. And this is typically the speculator. He takes the position, otherwise the market will be not complete. And it's not enough to say that we want to hedge the same amount of commodity. We also need the same planning horizon, and they have to trade at the same time. And this is a situation that not often occurs. So the speculator completes the market. Why speculators enter into the market? This is a good question because no one sees the reason. The point is there exists a lot of theory, and this normally goes about risk premium. About the risk premium. Speculator want to earn a risk premium. Someone want to protect the portfolio against inflation shocks. So a typical pension fund has the problem that it is long in bonds, and bonds, the value of a bond decreases if interest rates increases, and inflation is a point that leads to increasing interest rates. So a pension fund typically invests in commodities because it provides a kind of hedge against inflation. However, speculators avoid physical delivery. This is because it's really, really expensive to handle the commodity physically. Because, and you should imagine that a pension fund like here, or an investor here, they trade in Chicago. And if you come into delivery, you have to go to Chicago, take the grains, and have to sell them to someone else, farmer around. This is really complicated, and it is really, really expensive, so they avoid physical delivery. So they never act in the spot prices. And now, the question is, how can they influence? And it is also uncontested that future prices respond to supply and demand also from speculators, because the consumer enter into the market and have an impact on the price. The speculator, all of them, have an impact on future prices. But what we don't know is whether speculator have an impact on this spot price. Now, it's always, the typical argumentation is that speculators drive spot prices above the fundamentals. And that sounds clear because there's this typical behavior, and I don't know what they ever mentioned, but the point is, let's make an experiment, a typical experiment. We assume we have a spot market which is in a clearing situation with this clearing price. And now the speculators enter the market. And we assume further that the price increase above the fundamentals. What does it imply? It implies simply that the demand decreases. We see it here, because the people can always consume to this price, this amount, but at the same time the supply increases, because higher prices gives the incentive to sell more, and higher prices gives the incentives to buy low. So at the end of the day, we have a surplus. And the question is now, what happens with the surplus? If speculators drive prices above fundamentals, we should observe somewhere a surplus. And in fact, in a really competitive market, there is no reason that some producer do not sell this amount of commodity. I will now address how it can work. How speculative price increase in future market can impact the spot prices. To do this, we have to introduce then the speculative storage holder. As I have mentioned before, they act in spot and future markets to make profit from price differences. Now we can assume the following situation. We have a typical market. This is the time to delivery. This is the spot price. This is the price, and we have here the spot price, and here the future price. And we assume both are. Oh shit. Okay, and we assume this is the cost of carry. That means this is if you buy the commodity and store them. These are the costs that you have if you store a commodity until the delivery of the futures. And now we assume that this is an equilibrium, so you cannot make a profit from trading between both prices, because storing the commodity costs you exactly the difference. Now, in the next step, we assume future speculative enters the market. So they buy future contracts, and the future price increase above before. And what we also see is this here is a price difference. This is the clearing price, and now we can see this is a riskless profit. And this is a riskless profit for a speculative trading holder. How can they use this profit? This is quite simple. All he has to do is to buy the commodity in the spot market, store them, and sell at the same time the future price. This one. So this gives them, this is the cost, and this is the price difference that he can take into his pocket, let's say. So as a result, as he buy the spot market, the spot price increases, and at the same time, because he sells the future contracts, the future price decreases until no further riskless profit exists. What we see now is that the price has increased on the spot market due to a speculative increasing in futures demand. And we can say the speculative storage holder then simply absorbs the surplus. This is the mechanism how future speculation can impact spot prices. So the question is, how expensive is storage? We see here, this is the price of storage, including the spot price. And what I will show here is, these are the same future prices as I have shown before. And this is the break-even price, whether it's useful to make such a trading strategy, buy spot and sell future market. And we see the prices are mostly below this, the price of storage. So there is no incentive to make such a trading strategy. And this only occurs in rare circumstances and mostly when we have faced oversupply and not in a shortage. I will summarize shortly what we have seen before. Speculative storage holders link spot and future prices. The price transmission channel between spot and futures requires a storable commodity, so we have to be able to store them over a long time, a sufficient storage capacity, and, let's say, a profit opportunity. Storing grain is really expensive, but I'm not the most expert, but we have the data. And we can argue that financial speculation only harms if storage responds. We have to see that the storage responds if financial speculation enters the market. But we found weak evidence that they can do this. Now we come to another interesting actor, the manipulator. This is different because he wants to change the market price for their own benefit. What they need is they have to control a large fraction of the market, because you cannot change the market without being big. They can impact the spot prices directly by entering the spot market and make a scarcity there, or indirect over futures, but then the storage channel must respond. On another theoretical graphic, I know we are short on time. Maybe this graph is not so often presented, but what we see here is including storage demand, and this is the amount which is stored because of the clearing price here. And all we want to do is to simulate what happens, how can a manipulator impact this market. Well, we see, I simulate simply a supply reduction, and what we see, the price increase only moderate because we have a lot of storage that we can use to increase the supply. If we use now the same supply reduction, we see immediately a large increase in the price. And this is just because that we have lower demand, lower storage, and we have a decreasing price elasticity. And as a result, we should be really careful in such situations. Low storage is a really incentive to make manipulation in the market, because you only need a small amount of physical supply to have a large impact in the prices. And from this perspective, we can say manipulation is most damaging if stocks are low. Or we can also say from the perspective of manipulators is really effective. Now, what we see here is national measure protection programs. And during the price spikes, we see that many countries have decreased the supply. And this is the graphic that I want to show. What we see here is the stocks-to-use ratio. That means the inventories. Low inventories, high inventories, and this is the price for wheat during this time. And what we see here is that if we have high inventories, the prices are low, and this is the time between 1995 and 2006, this is the black triangles. And the time when we faces the price spikes is exactly the asterisks here between 2007 and 2008. And if we compare this with what we have seen before, then the stocks are really low, and in this time, the government reduces the supply in the world market. And what we see here is incredible price increases exactly during this time. And this is why I think manipulation, they just manipulate the market. And on the other hand, this is the rice market, the same example, the price increases 250%, but what we see is here a many supply reduction, increase of demand by the Philippines, and this also results in high prices. And what we can say is that insulating policies account for 45% of the rise pricing, according to the study of Haase and Fan, and protection rates explain around about 30% of the wheat price surge. Now, I give the summary, and I'm really short. The price increases is due to demand and supply imbalances. We have weak evidence that financial speculation can impact prices, and the trade policy multiplies the price increases. This is really important, and low global inventories increase the price impact of policy measures. The solutions is, from our perspective, we need a sustainable production goal in line with consumption to reduce the impact of differences. Then we need definitely a reduction of social price protection policy, and if we cannot do this, we need global inventories as a buffer against supply and demand shocks, because this is the only way how we can reduce shortages in supply. So.
I'll live up to my words. I'm tough on time management, especially if my food is concerned, and I want to get this dinner tonight at the Titlers, so I think it's in everybody's interest. A very interesting presentation. I also know a high degree of complexity, I guess it's fair to say, and we open now the forum for the audience actually to ask question or comment on what you just heard. Could I see hand signs, please? Maybe we start with the lady over there, and then we go to the gentleman in the back.
Angela Tobler, Bern University of Applied Sciences. I was intrigued by your solution proposals, because you were talking about the financial markets, but all the solutions that you proposed were outside the financial markets. So I would like to know if there is anything inside the financial markets that could be done.
Well, the point is, first we have to think about what we wanted, what is the result. Should we have low prices to feed the world, or shall we look at the impact of financial speculation? That for there is no really a theory, and we do not find any great impact. And on the other hand, we see there is a really clear impact in the market, and should we focus on that? Because the financial markets are really highly regulated. This is the highest standard that you can imagine. And if we want to regulate this market, we should first look at the storage, because this is the only transmission mechanism, and we have no idea how the storage is, the private storage works. So you can imagine that they work behind the public storage capacities. And this is why I would say, okay, we can look at the financial markets, but the impact is so low that we do not solve the problem that we face at the moment with high prices. This is the reason why I changed the topic and the results.
Okay, the gentleman over there in the blue shirt with the, exactly. And also, I mean, your predecessor, she did it perfectly. Just introduce yourself, who you are and where you come from.
My name is Ivo Muri. I'm an entrepreneur from Switzerland, and I was reflecting on the question of money during a long time. And I'm very happy that at the university also you're going to think of how to organize money. And I want to give a political statement on that. And then I will propose you a new solution you might never have heard maybe, but which is very easy. So the political question is, if we want that the whole humanity has enough food, then we have to think of how to organize that it works. If we accept that it is only the survival of the best, of the fittest, that must survive, then we can continue as we do now. So in my opinion, we should organize the economy in a way that every human can survive. And for this, he needs food. And what I brought you here now is an insurance which was written in 1923. And what we find here is that at this time in Germany, 1923, money was gauged with corn. You can read on that there was an insurance made for somebody, not in Deutschmark, not in dollar, but in Roggengeldwert. So the equal of corn for to survive. This was in 1923. What I want to tell you is that if we don't gauge money with something, we won't solve the problem. And this something must be the basic of everybody. This is food. So we have to gauge money with food if we want that everybody can survive.
Would that be a solution, that we don't have a gold standard anymore, but a grain standard?
Okay, well, this is a really good point. First, let's think about what can a market do. A market is a distributor between supply and demand, and the price is what we observe that clears the market. This does not mean this is a fair. It's just the people with the highest income can buy the most commodities. And this is the distribution that provides a market. And we know this is not always a good solution. Then we have to think about what happens if we run into a shortage. So should we let the distribution do the market, or should we enter and say, okay, we give each person the same amount of food? This is typically what we normally do, but it's an extreme situation. And what you mentioned, as mentioned before in 1923, it is before it was in Germany, there was the grain market. It was in Berlin. It was the greatest grain market in Europe. And in 1895, they closed them because the prices were too low, and speculators were blamed for that the prices are too low. So they closed the market, and at the end of the day, they have to reopen it 5 years later because the result was a disaster. The farmers and consumers were not able to hedge their price risk. And when they opened the market again, the people moved to Paris, to the grain exchange in Paris. And the grain exchange in Paris is today still working, in Berlin not. And this is the point that we have to think about. If we close a market we don't understand just because we think the speculation is responsible for what has happened in supply and demand, without that they have an impact in the supply and demand, then we come maybe to the same result of we close the market with higher volatility afterwards, and the people make it on other places in the world. And maybe they are not well regulated. And if you use grain as a monetary base, I don't know, rice was it in Japan in the 70s? No, I just want to give you the mechanism.
I think maybe we take this side now and then one statement from over there, because we are short on time. So keep it very brief, okay, so that we keep the time schedule.
I'm Johannes Hunkler. I'm agricultural student at ETH. My question is, a lot of banks say they get out of food speculation. Now, is the market getting incomplete? Or maybe if you have fewer banks speculating, is that a problem because speculators could become manipulators when it's just a few of them?
I'd say, well, I have to add that the banks who announced to get out of the business, I'd say I speak for the future markets first. Because we had a couple of banks, especially in Germany, which decided to stop products with, for instance, agriculture-backed commodities. The amount invested was rather small, so there was actually no impact. Because you have quite a lot of opportunities to move to other markets. I mean, you have in Germany these banks, you can move to another bank in the United States. So you had no impact. If you had on a global scale that you ban, for instance, investments in agriculture commodities or commodities overall, you might have the problem that the risk transfer and hedging mechanism doesn't work anymore. And that would be a serious problem because someone else would have to sell the insurances. Probably it would be Swiss Re or another insurance company but for sure they would demand a premium on that, probably not the lowest. So we have quite an incentive that a lot of, say, speculators which sell insurances on the market are in place, so that the premium shrink actually. Yeah.
To answer also the question whether the markets are complete, we see it in Paris. The markets are not really complete because they are not liquid. If you try to hedge your price risk as a farmer for the next season and the over next season, you can't do this. The contracts are liquid only to the next 7 months, but not to a full year. And you have a planning horizon for more than a year, normally 2 years as you are a farmer. I mean, you know it better than me. But they are not able to hedge their price risk for the next 2 seasons. And this is the highest risk that they face a farmer in Europe. Otherwise, they go bankruptcy or the government has to help them with additional money. This is the way that they are not complete. It's also the speculator cannot trade in this market because it's too illiquid. They cannot close their position, and they face the probability that they have to deliver, but they can't. So they don't enter the market. It's too risky for a speculator to enter an illiquid market.
One last question from that lady over there.
So my name is Vera Eichenauer. I'm a PhD in economics. And what I take from your presentation, that we have the problem that both demand and supply are relatively inelastic. So whenever there's not, when there's a change in one or the other, there are pretty fast problems. So I think it's very important to talk about the ownership of these inventories, what you aimed at. I mean, when you speculate that demand is increasing further, you might want to store it for 2 years and then you have a huge profit. But what I don't understand, and what I think you didn't explain so much, is why did we see this spike? I mean, I understand the long-term trend, but why did we see this massive spike in the end of the 2010s?
Well, maybe I try, it doesn't matter, it doesn't work really. So the point is that we can buffer the price spike by drawing out inventories. We use inventories as additional supply. And if the inventories are really low, we cannot use them. And this means at the same time, if we stop to draw out inventories, it's the same result as you reduce another supply. This is like another negative supply shock. And onto a specific point, it was the graphic before, then the price jumps because the people start to pay more, or at least governments and countries pay more just to keep down the population, than not to start a revolution or something else. So the government start to pay to reduce insurance taxes. They do a lot of things just to bring the supply into the market, and they pay really, really more. And we don't have the supply, and the demand increases, and then the price only stops if the people stop buying physically.
So you argue it's a government distortion, basically?
Yeah, it is, definitely.
I should say it loud, a government distortion. That's what I hear from your answer.
Yeah, right.
Maybe we keep it at there. I hate to keep that short because I know it's a highly interesting topic, but we have 2 other speakers waiting for us. But before, there's somebody coming because there's a little thank you present from the Academia Engelberg. Thank you very much for your insights, and they're available for questions.